Hi there and welcome to my Q2 2025 market update and economic outlook. It has certainly been an eventful quarter to say the absolute least. From the freefall we saw in early April from Liberation Day when the tariffs were announced, to seeing both the S&P 500, the MSCI World Index and the All Ordinaries fully retrace with some markets reaching all-time highs. Plenty to unpack in this video today. We are seeing strong corporate earnings. We are seeing some weakening economic growth. We've had the big, beautiful bill from Trump announced and plenty to dive into. So we'll touch a bit on global macro events. We'll dive into the regions, what's happening on the ground in different countries and regions all around the world, what our outlook looks like going forward. We've also entered a new financial year in Australia as of the 1st of July. So we'll touch on what that means. And of course, what we are looking at, what we're monitoring from Q3 and going forward. So let's start with global markets. What has happened over the past quarter? Let's dive in. Starting off with global markets, we did see a sharp sell-off when Liberation Day was announced in early April. That was effectively the significant blanket tariffs that Trump announced on effectively most trading partners around the world. Naturally, that caused some fear, some panic, and had they come through as was originally announced, that no doubt would have had some downward impact on many economies right around the world. Now, that has all largely been walked back, and of course, we've recently seen the expiry. We've seen a number of trade deals announced. We will touch on that a little later in this update. But that has largely been walked back. And what that has meant, as I mentioned earlier in this update, is that we have seen global indices fully retrace that earlier sell-off. So anybody who panicked during that early period of volatility is well and truly underwater because markets have recovered. It has been quite widespread. US, Asia, Chinese equities in particular have seen a very strong run, and Europe has also. Even Aussie markets have seen a pretty good run over that same time period. We have seen corporate earnings upgraded in many major economies, particularly in the US. Hasn't been the same case in Australia. We'll touch a bit on that later as well. And we're also starting to see some fairly positive economic data that is released as these tariffs are wound back and new trade deals are announced. So overall, a fairly positive quarter, despite the fact that we started on very volatile ground. Now, looking at some of the global major events that we have seen over this quarter, there have really been two. One has been obviously the tariffs that were announced early in the quarter, and that was effectively a blanket tariff. It was going to be significant and steep, and that has largely been wound back. We've seen two fairly significant trade deals announced with meaningful trade partners with the US, and that has been between China and Vietnam. And both of those are significant markets for the United States. So naturally positive news, and it's very likely that we will continue to see more and more announced over the coming days and weeks as those tariffs or as those sort of tariff pauses do actually expire. So no doubt we'll see some fairly positive news there. Now, there has been a lot of talk, a lot of concern around, well, why haven't we seen an update in the tariffs and the trade agreements with Australia? Why aren't we seeing open negotiations between the US and Australia on this topic? And the reality is, Australia is not a meaningful exporter to the United States. Yes, of course, there's some beef, there's some wine, but in terms of a trade partner, Australia is certainly not as meaningful to the United States economy as Vietnam, as China, as many of these other trade partners are. So despite that fact, it is very unlikely to have any meaningful impact on the United States economy. Now, the other big update that we have seen recently that has received a bit of traction is the passing of Trump's One Big Beautiful Bill, OBBB, as it has become known. Now, this presented a number of announcements, and effectively, among many things, it's an extension of Trump's tax cuts. Now, the only way he was effectively able to afford those were when bond yields came down, thanks to the tariffs largely being wound back. So the One Big Beautiful Bill, amongst many other things, is going to cut Medicaid spending, cut spending on green energy, and significantly increase tax cuts. Now, what that's going to mean is that debt is going to continue to spiral in the United States, to the point now where markets are expecting that US debt will hit 15% of GDP by 2034, and that the bill is expected to create an additional $2.8 trillion worth of debt. Are the markets worried? No. Are bond yields starting to increase to some extent? Yes, we are starting to see some movement there. Bond investors are starting to demand a higher return there, but we don't see a huge amount of upside, and therefore within our portfolios, we're looking more at Australian government debt than we are the United States. Of course, watch this space. There was also some talk for those Australians living in the United States around an additional remittance tax being imposed on money that was sent outside of the United States. Started with an original proposal of 5%. It was then watered down to 3.5%, which would effectively be returned for anyone with a social security number. And that has now landed at 1% for money orders, cashier's orders. So effectively should not have any impact on anyone using a transfer service like an OFX, TorFX, Wise or XC. Of course, do your homework, seek advice, but some fairly positive news there for what could have been potentially a bit worse. Now, let's dive into some of the regions in terms of what's happening in the United States, Europe and the UK, China and the rest of the Asian markets, and of course, back home in Australia. Now, starting off with the United States, we've already touched on the One Big Beautiful Bill. We've touched on the trade deals that have been announced, which have naturally been positive. What we are also starting to see is some fairly positive GDP data released by the various analysts and via the central bank also. Now, what that has meant is that Jerome Powell, despite the fact that Trump would love to see rate cuts in the US, naturally that would be buoyant and have a positive impact on growth assets, particularly the stock market. He could then take credit for that and naturally boost his popularity. But Jerome Powell, the central bank or the Federal Reserve, is really not looking to cut rates in the short term. Now, that may have an impact on the US dollar and naturally the Aussie dollar as a result of that as well. But some fairly good news there. We've also seen very strong corporate earnings and employment data released out of the US as well. So both those things being largely quite positive for the US. If we look at economic sentiment, consumer sentiment, business sentiment, it really depends on the political lines. If we look at the Democratic view, most people are expecting that the US economy is going to go to hell in a handbasket, whereas if we look at the Republican view, it is the complete opposite. Now, where is the reality? Of course, the data will tell us. And what we are monitoring probably most closely are those US bond yields, because that's really going to define what confidence investors have in terms of those US debt levels or concerns for that matter, and naturally what corporate earnings look like going forward. So all things being equal, we do see some continued upside in US markets. Let's dive into the European and UK markets. Now, across the UK and most European markets, we've seen fairly mixed results. We have had a fairly positive first half of 2025, calendar year 2025 in European markets, even the UK. Central banks throughout the region were cutting rates and now taking a bit of a cautious approach as to what happens next, and naturally we'll be watching those economies going forward. We see some upside in some of the more stable parts of European equity markets, Germany, Switzerland, France for that matter, but we're not looking to add a huge amount of exposure just yet. We'll certainly be monitoring that, monitoring population growth and general economic activity in that region. We'll also be monitoring the exchange rates as well, particularly given a number of our clients have UK pensions and exposure to particularly the British pound, and we'll need to monitor what that does in relation to other currencies. Let's have a bit of a look at China and other Asian markets. Now, I mentioned earlier that we have seen trade deals announced with Vietnam and China and the US. Now, what that has meant, other than it being much more positive than was originally announced early April, is there is now more stability, more clarity on what those numbers are going to look like going forward. Will it be inflationary? Yes, of course it will. There is really very little doubt about that, but far less than what it would have been. So that's been good news. We've seen China as a bit of a standout performer over the past quarter. We did see a bit of a sell-off early into Q2, and we've seen quite a sharp rally since then. We certainly believe that there's further upside in Asian equity markets, Vietnam, China, India. Naturally, there will be volatility as these geopolitical tensions continue, but we do feel that there will continue to be more upside. Singapore, Hong Kong, we think will be a little bit more mixed, largely based on property and financial services. Both markets we do expect are going to be fairly stable moving forward, particularly as Hong Kong property does start to recover, although I think that'll be a bit of a slow grind moving forward. Let's have a bit of a look closer to home back in Australia at what's happening in equity markets, what the RBA is doing, what the Aussie dollar outlook is, and of course, what the outlook is for Australian property prices. Now, in terms of Australia, we have seen equity markets in Australia fully retrace from that early sell-off in Q2. But unlike the US, it really hasn't been driven by widespread earnings growth. If we look at the major constituents of the Australian indices, being the banks and the miners, we really haven't seen strong earnings growth there. CBA being a bit of a standout at a ridiculous price level at the moment. Will it continue? Well, we'll need to dust off the crystal ball to be able to answer that one. But with valuations and price to forward earnings trading at the levels it is, I would certainly be questioning further upside there. But outside of those sort of major constituents of that index, we do see quite a bit more upside in sectors like technology, like healthcare, even some of the consumer staples and consumer discretionary players in the Australian market. From a central bank standpoint, we did see the Reserve Bank of Australia keep rates on hold at 3.85% at the July meeting. Now, that has meant that the Australian dollar has seen a little bit more stability, but the expectation that is widely held is that the RBA will need to cut rates 2 to 3 to 4 times over the next 12 to 18 months. And that is the view that is widely held by banks. There was about a 93% expectation that the RBA would actually cut rates in July. They have cited that there is some worry or some concern about upside risk to inflation. Personally, I think that's complete nonsense. But here we are. Sadly, I don't sit on the RBA board. But I think we can all agree that the direction of rates in Australia is to the downside. But will that be more aggressively than other economies like the US, like European markets? I think that's a little bit unlikely. In terms of Australian property prices, if we look at the consensus forecasts, most are expecting that both the West and Eastern seaboard markets are going to see somewhere between a 5 and an 8% annual return over the next 12 months. Of course, take that with a pinch of salt, and not all properties move at the same pace or even in the same direction. But generally speaking, most are expecting that residential and commercial property are going to see a reasonable uplift over the next 12 months. Now, in terms of the Aussie dollar, naturally as expats and as I sit here in Singapore, looking at around the 120 level, give or take, Singapore to the Australian dollar, and similar weakness when we look at the US dollar to the Aussie. Now, yes, there might be a little bit further downside depending on what the RBA does relative to other central banks, but personally, and for many of our clients, if you are planning to retire in Australia, spend money in Australia in future, it may not be a bad idea to start considering your exposure to the Australian dollar. We don't need to actually zoom out terribly far to realise that 120, 121 is a pretty attractive rate Sing to Aussie. So do with that what you will. So all things considered, a fairly positive outlook across global markets. We are cautiously optimistic. In the fixed income space, we are more bullish on Australian bonds, Australian government bonds particularly, than we are in the US. In equity markets, again, we are relatively bullish, particularly on international, whilst being a little more selective with Australian equities, where we do see some further upside, particularly if the Australian dollar does appreciate from here going forward. So all things being equal, a relatively positive outlook. No doubt there will be more volatility, but we do expect that the tariffs and the trade agreements that are announced over the following quarter will be fairly positive news. So if you have any questions at all, please reach out, drop me a note. Would love to have a chat. And of course, ensure that your investments are aligned with our outlook going forward. But thank you very much for tuning in. As I said, drop me a note with any questions you have. I look forward to speaking with you soon.